All right, well, everybody, welcome to The Complete Advisor. We have a very special guest on the podcast today. I'll introduce you in just a second, Miss Becky. But before I do, I want to remind you of a couple things. So one, of course, we would love for you to subscribe. Look for that little like button, grab it, hit the subscribe button. If you do that, that way you're always notified when we put out, when we drop a new episode. And we're dropping a lot of them, and I can't wait to put this one out because it's going to be awesome. But we're on everywhere. And in fact, what's really cool is if you check us out on YouTube, Spotify, or Apple, you can watch us or listen. And then you can actually, if you just want the audio version or you go somewhere else, iTunes, Pandora, iHeartRadio. We're everywhere. There's so many. Google, we are out there everywhere. But our topic today, this is something I'm very interested to talk about. We've got the perfect person to talk about it with. A lot of advisors tend to stay in the lane of doing financial advice. And it's easier on one hand to focus on balancing portfolios, rebalancing portfolios, looking maybe at long-term care, doing these different things. But one thing that I've noticed through the years is that a lot of advisors don't gravitate towards maybe the best financial product that's ever been invented in the world, and that's life insurance. And so we have a expert on life insurance, truly, but we also have a Washington insider, and I think that really plays in your knowledge of taxes and such, really plays in, and your approach to taxes. So I'm teasing a lot here. But I should do a proper introduction here. So I have Miss Becky Swansburg sitting across the table from me. I'm going to brag about you a little bit here, and I'm going to do it looking at your bio because it's very impressive. So CEO of Stonewood Financial, you've written a couple great books, The No Compromise Retirement Plan, The New Rules for Retirement Savings, and I'm a big fan of the New Holistic Retirement. I think that one is awesome and should almost be required reading. Nationally recognized public speaker. I have seen you on stage personally, and you do a magnificent job.
Thank you.
And then, look at that, I'm just like, yep. And then you've been up on Washington. We were just talking before we turned the mics on about your experience up on Capitol Hill, which is fascinating. So, Becky, welcome.
Thank you for having me.
It is awesome to have you here. So we go into let's just dive right into the first part. Why do you think more advisors don't get into life insurance like they should?
Yeah, it's funny. At my grandmother's house, she had this old rotary telephone on the wall. Mm-hmm. And when I would go to her house, I thought it was so cool to try to play with this rotary telephone and listen to it click, 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 click back, which I'm sure some of our listeners remember. Uh-huh. I think most people still think about life insurance like that rotary phone on my grandma's wall. So they think about it, and what did that phone on the wall do? It made a phone call, and that was its only purpose. A lot of people still think about life insurance as just being about death benefit protection. Yep. It kind of has one purpose. But today, if you ask me what a phone is, I'm thinking an iPhone, a smartphone. Mm-hmm. That phone, yes, absolutely can make a call, but it's also a camcorder, and it's a camera. It controls my thermostat. Yeah. I can FaceTime people. I can listen to the radio on it. It is so much more. And that's really what modern life insurance is today.
That actually is one of the best analogies that I think I've heard in a long time, because that is so true where, we do think of life insurance just, okay, you die, somebody gets the benefit. And then the reality is just like my iPhone, I can do all these different things. Oh yeah, and I can make calls too. Yeah. Like it's it's one of the last things, and that's the same thing. Talk a little bit about, so in the book, The New Holistic Retirement, you all talk about looking at taxation differently than I think anybody else really approaches it. It's much more proactive than reactive, but talk a little bit about that.
Yeah, when I look at the risks facing American savers today, they're kind of what I like to call the risks they know and the risks that are really dangerous, but they're not focused on. So everyone knows about market risk. We got to grow and protect our retirement assets. Because of the work of a lot of advisors, now a lot of American savers understand income risk, that risk of outliving your income and maybe wanting to incorporate some annuities to hedge against that. But the two largest, least understood risks that face American savers today may be tax risk which is the risk that your taxes are higher in retirement than they are today, and that means more money to the IRS, less money for you to spend. And then closely related to that is what I like to call legislative risk.
Yeah.
And legislative risk, which is very heightened in recent years, is this risk that Congress comes in, they change the rules. Suddenly, the rules you saved under aren't the rules you can access your fund under, and you end up with less retirement money.
Now, I do have to give a massive shout out to one of your colleagues, Neil. We did an episode where we talked about legislative risk, and that is fascinating that, those are things that we don't take into account a lot of times. So we think about, like you were saying, mortality risk. Are you going to outlive your money? Now people are actually thinking about inflation, which as a side note, think of all the years that you've seen that same old slide where it would show inflation, like a movie ticket in 1955, and everyone just kind of is waiting for the next slide. And now all of a sudden it's like, wait, what's the price of eggs?
Right.
Now we're actually all paying attention to inflation. But you're so right. So we have this pandemic, and you talk about this in the book brilliantly. The fact that I'm going to blank on how you say it, but looking at the impact of the pandemic.
Yeah. Well, if you look right now, our federal debt sits at about $31 trillion with the T.
That's a lot.
Yeah. And actually, I believe that the recent pandemic spending was the most rapid accumulation of U.S. debt since World War II. So we passed, $3.5 trillion spending bill, $2 trillion spending bill. We have amassed all this debt. And there are really two main ways that our government can lower the debt. It can either have such massive economic growth that they have so much tax revenue, they don't know how to spend it all, and they assign some of that to pay down the debt. I think most of our listeners would agree that seems less likely.
Yeah.
And the other way they can do it is they can raise taxes. So I think most experts, myself included, see that we are entering into a rising tax environment, that we have spending priorities in Washington. We have demographics that are aging, so we have more strain on Social Security, on Medicare, on Medicaid. We have all of these kind of forces that are just going to drive taxes higher and higher. The challenge is most Americans have saved the vast majority of their retirement savings in tax-deferred vehicles, which means that if their taxes are the same or higher in the future than they are today, they may end up not getting a good deal out of a 401k or an IRA.
Do you think so? I've had this thought bouncing around the back of my head for a while, and they say when it comes to the military that the military prepares for the last war instead of what's coming up. I feel a little bit like people that are getting close to retirement, we're actually preparing for like our mom and dad's retirement instead of the reality that's coming up. So the reality, everyone always said the idea like, oh, Becky, you'll be in a lower tax bracket when you're older. That's why we're doing it this way. And there's just so much, not to be political, there's just so much stuff that's got to get paid for. And like you said, there's only two ways it's going to happen.
Yeah, I like to call that almost the great American savings myth. It is this myth that for most of us, we will be in a dramatically lower tax bracket in retirement than we are today. Now, when I look at my parents who are baby boomers, reaching retirement age, they don't want to live less of a lifestyle in retirement than they do today. They want to take their grandkids, the thing that matters most to baby boomers, on vacations. They want to eat out. They want to travel. So their income needs are not going to be dramatically lower in retirement than they are today. So they're most likely not going to be in a lower tax bracket than they are now. Layer on top of that things that are totally out of control of my parents that have nothing to do with Mickey and Marty Ruby living in Louisville, Kentucky. We have a nation that is uncontrollably spending money.
Yeah.
And we need taxes to pay for it. We have seen with the Build Back Better legislation that's been bouncing around Washington the past 18, 20 months, trillions of dollars in new tax and spending proposals coming out of Washington. And what was surprising to myself and a lot of experts in our industry was how much of those new tax proposals were focused in on retirement assets.
So that's it. That is very interesting. So, and that's the legislative risk that you all talk about, and Neil talked about too. But that thought of, you're putting your money and we're putting it in the 401k, and it's going to grow, and it's getting that advantage of deferral. How big of a concern do you think that should be for somebody that you could lose your deferral? Would you get grandfathered, or would it just be like, hey, tough cookies?
No, it is tough cookies. That's one of the big risks, I think, of 401k and IRA money. And look, I have IRA money, I have TSP money from my time in the government. I've got Roth, I've got Index Universal Life Insurance as part of my retirement approach. But when all or the majority of your funds are in these tax-deferred vehicles and you don't have any diversification, you've opened yourself up to a lot of legislative risk. And here's why. So when Congress passes a new law that impacts 401ks or IRAs, those new laws take immediate effect, which means suddenly the rules I was promised when I put the money into my IRA are different than the rules that I have to take that money out under. The reason I love incorporating Index Universal Life Insurance as part of the tax-free portion of my retirement assets is because it's not an account. Life insurance, it's a contract. And contracts are legally very different. When Congress passes a new rule on a contract, all the existing policies are grandfathered in under the old rule.
Well, that's interesting. So how does that, so if that's contract law, but how does that, so on annuities then, I guess the contractual structure would stay the same, but you could lose the deferral over there? Or
annuities are a little different. They are contracts too, but if that annuity lives within an IRA, then the money passes out of the annuity within that contract, but has to go through the barrier of the IRA, which is an account, which is then ruled by whatever new rules Congress and the president dream up.
I gotcha. So one, that's really fascinating. And then so going back to a lot of advisors where I see this here. I see this when I was in private practice, where they would shy away from life insurance. And I know on one hand you can find programs where somebody will tell you that whole life is the only thing you should have, and every nickel should go here. And I know that there's no one thing. There's you balanced diet like that. But talk a little bit about why you think advisors don't. I mean, I have my theory, which is underwriting scares them. But
that's part of it.
What do you think?
Well, I think part of the challenge is that it's not naturally where they've kind of grown up. So if you think, what are the things that you did? You either manage money or maybe you started in the annuity business, and those two have cross-pollinated pretty heavily.
Yeah.
The challenge and the reason why I think life insurance is such an important place to focus right now is we are in an era of diversification because we are in an era of instability and unpredictability in Washington and in our industry. And I think any time that you have the market and inflation and there's a recession coming and we are just in this very insecure environment, we have to make sure that clients are protected for whatever the future might bring because it becomes very difficult to predict that future. Yeah. And so the vast majority of our clients are not 100% equities exposed. We've diversified their market risk. Hopefully we've helped them with some guaranteed income versus variable income. We've diversified that. But when it comes to taxes, so many American savers have no diversification in their retirement approach. So this isn't about clear out your IRA, go buy a Roth, or go buy life insurance. It's really about how do we make sure that we're diversified against taxes the exact same way we're diversified against market forces and other income needs and longevity.
So we've had you, I mean, we have a relationship with you for full disclosure, transparency for everybody. Yeah. And we've had you speak to advisors. And what's their response when you talk about, because that's what I was looking for from the book. I could not remember the diversification on your tax exposure. How does that message get received? Is it like a stunning eye-opener?
It is. I would say most Americans right now have a little bit of insecurity in their belly about taxes. But no one really talks to them about it in a macro sense. So a lot of people talk about that micro year-by-year tax planning that goes into retirement. That's not where the real impact can be made. We have to look about limiting lifetime taxes in retirement, a very macro approach. And that is something that many savers have never been approached by a financial professional about, which is a huge opportunity. I know, I got so excited about that opportunity, I'm wiggling in my chair. It is really, I think, one of the primary conversation openers with savers right now, particularly with higher net worth savers. And we hear from advisors here at Creative that the more we talk about taxes, the higher net worth clients they're bringing in.
I think, correct me if I'm wrong, this is another one of my own theories here. Yeah. With all due respect to CPAs, I feel like CPAs are almost chroniclers of history. Like they're dealing with what was and making sure that it's reported correctly. That's and it's maybe it's a time factor, maybe it's just what that's their industry, that's what they do. They don't take that forward-looking view, and that's where financial advisors need to come in.
Yeah. I mean, it really is amazing that most people have never had their retirement tax bill quantified for them. So most people know kind of the benefit of tax deferral. Every year I've gotten this write-off. But one of the first reports that Stonewood, my company, developed for advisors was this ability to say, let's look at the cost of tax deferral. Let's look at the potential retirement tax bill that this client is building up over their lifetime in retirement. And let's just ask the question, Mr. and Mrs. Client, are you happy with a $500,000 tax bill on $800,000 portion of your IRA? Or would we like to mitigate some of those taxes with some tax diversification?
That's interesting. So do you, is it almost like a Monte Carlo simulation of, the depending on who's, in office and how it goes?
Not even that complex. It really just let's look at all the places that IRA money might be taxed, because it's not just taxed when it comes out to you. It's also taxed if there's anything left in that account and it goes to your heirs, to your spouse, or to your kids. And then what happens if we just pay those taxes today? It's a critical conversation actually right now, up in the run-up to 2026. Because as listeners might remember, the Trump tax law, that big federal tax cut that reduced tax brackets on millions of American filers, both of us included in this room, probably all of our listeners, those all expire in 2025, which means in 2026, all of our tax brackets are reverting back to their older, higher rates. So if you're going to change the tax status of a client's retirement benefits, we have a short window to do it at an artificially low tax rate.
Little fire sale.
And it's coming.
So when it comes to this is great. So now we're going to kind of vaguely veer into little politics, but not party politics, anything like that. But your experience, so we were talking before, so you've been up on Capitol Hill. Let's lay your bona fides out there. So what were you doing up there?
Yeah, so I worked in the White House under George W. Bush during his first administration. I popped over to Capitol Hill, worked for Speaker Denny Hastert when he was there, and a couple different members of Congress doing communication and policy work.
Okay. So you know the ropes up there. So with the sunsetting of those, I mean, we've potential.
Yeah.
But the reality is that more than likely they will, and something else will come out. That's how that typically works. No one ever votes like, hey, let's go ahead and extend it, because it was the other parties or the other administrations. Even if it's the same party, it was that guy's. I want my own.
That is exactly right. You have figured Washington out to a T. Look, some other Congress and president got credit for those tax cuts. This Congress, I think, will most likely let them expire. Actually, if you look at tax cuts going back to the Kennedy tax cuts in the 60s, most packages are just let to expire. Because look, Congress gets more tax revenue. They never had to raise your taxes. They didn't have to take a single vote. It expires, and suddenly more tax revenue rolls in.
And then you can be a hero or get credit for whatever your proposal is.
Whatever package you do next.
Do you see, now that you're not up on the Hill, do you see the ability to get that done, or is it just going to meander maybe?
I think we might see small packages, but if we look, retirement is not a 1, 2, or 5 year, we hope, experience for most people. So if we look over the 10s and 20s and 30s of years, there is no scenario I see where we're not in a rising tax environment. We have too big of a debt. We have an aging demographic. We have all of these spending needs. And that is going to require more tax revenue. And I feel like over the past maybe a year and a half, Congress has really tipped their hand. It's like we're sitting around playing poker and we've seen their cards.
Yeah.
And a lot of that hand was looking at how particularly higher net worth Americans have saved for retirement. And by the way, what Congress thinks is higher net worth and what you might feel is higher net worth, very different. Americans just that have had good careers, made money, they're looking at those retirement assets saying, we are sitting on a gold mine.
Yeah.
How can we get a little more of it? So I'll tell you one interesting example. We saw in the debate of the Build Back Better legislation, and this provision didn't pass, but it's just sitting on the shelf for future use up there, a new provision that savers would add up all of their retirement assets, 401ks, IRAs, pensions, Roth accounts. And if the total value of those assets exceeded an arbitrary amount that Congress got to set, there would be a new required minimum distribution each year equal to 50% of the excess funds. So Congress would basically come in and say, hey, Dennis, sorry, you saved too much for retirement. You have been greedy. I don't care if you want to retire early. I don't care if you live in a high, cost state like California. We have decided you've saved enough, and now there will be tax penalties on the money you've saved over that each year.
The cool thing is for us lay people that aren't students of the game of legislation like you and Neil and the rest of the team are, how serious was that taken?
Here's the challenge. Every time Congress meets, they have the ability to pass new laws.
Yeah.
And we as voters really only 2 years have the ability to then change the leadership that's there.
Yep.
So sometimes people will ask, does it matter if the Democrats win or the Republicans win the next election? And it really doesn't. The volatility comes from our 2-year election cycle in a two-party system. Because every 2 years, totally different leaders with completely different priorities might be in Washington.
Yeah.
And so I like to say, they say tax proposals never die. They just go on the shelf for future use. It is like dodging bullets out there. It is like every time Congress meets, we have to cross our fingers and hope they don't pass laws that negatively impact all of our clients and leave them with less income than we've planned for them to have in retirement. One of the reasons that I like life insurance, we talked about it being a contract. We talked about it being out of the reach of Congress. You can quit dodging bullets with that money and just get it out of the line of fire, so that you at least know you have a portion of your retirement assets that Congress really can't touch.
Yeah, that's that's fascinating because I get to look at a lot of books and I see conversations about Monte Carlo simulations and diversification and what's your global position versus domestic, and never ever do I ever see really that conversation about diversifying your tax exposure. Which is why I think that book is so brilliant.
You know what I think is crazy? If you look for middle American savers, kind of middle America, tax rates 20 years ago, tax bracket rates were about 30% higher than they are today, which means all of our brackets could go up 30%, and we wouldn't even be in a high tax rate environment. We would just be back to kind of the historical norms we were all used to paying in the 90s and the early 2000s. So there is a lot of leeway. And it's funny, advisors work so hard to position their clients to maybe get them an extra, 8%, 10% on growth. Well, if taxes go up 30%, we've eaten up all that growth.
Yeah.
Because now that growth is going to Washington, it's not going to your client.
That's fascinating. The program that you guys have is it is a great program. It's something that people should look at, or at the very least, an advisor should get a copy of that book of yours.
Yeah. Well, they can get connected with you. We'll give them a copy.
All right, fair enough. Okay, different note. I want to hear the answer to this. So you and I were talking before, and I think this is pretty fun. So we were talking a little bit politics. We were talking about your time
and
up there.
Trivia.
And we were talking about trivia, and you threw a trivia question to me, and I said, don't tell me the answer, save it. So for everybody that's listening or watching, the question was, we were talking about politics in general. Again, we're not getting, there's no...
Yeah, this is going way back, before Republican and Democrats.
Yeah. Okay, so the question that you asked me was, you said, who is the only U.S. president that kept their campaign promises?
Kept all of their campaign promises.
All. Folks, literally, we need to write that down. Like a politician that kept all of their campaign promises.
It was James K. Polk, our 11th president.
And keep going.
And you said, what are his campaign promises? And now I'm on the spot. I got to remember. Okay.
Well, so how many were there?
He had exactly 3 campaign promises. It is actually a great study in focus your promises and make sure they're things you can deliver on.
Was one of them like open bar at the inauguration?
Yeah, that's right. Come see me, I'll give you a penny. No, he had land acquisition. So as you know, won the Mexican-American War and got the entire northwestern portion of the United States.
Oh, interesting.
So America grew more under James K. Polk than any other president.
Really? Even more than Jefferson?
Yeah, pretty much the entire western United States came to us under him.
Fascinating.
Let's see. His second one was tariffs. He reduced the tariffs to stimulate international trade.
If you get the third, I'm going to be super impressed.
I do. He built an independent treasury. Independent treasury. There we go. Now, maybe some advisor is listening that is also a presidential scholar. And if you are, maybe comment wherever this is and let me know if I got that wrong. I think I got those right.
I'm going with it because you had the 3 and you had the president and you had it in the correct order. I'm assuming because I don't ever remember I never had to take a test on order of the president.
Yeah.
So.
obscure presidents are just interesting to me. I actually think one of the things that's interesting about him is every president was a little bit famous in their own time. So we've kind of forgotten them, but
yeah, isn't that fascinating?
it was important then. But also I do think it, to bring it back to financial advising, I do think we don't have to get overly complicated with our clients, just like James Polk did not get overly complicated with his promises. Really what we've done is we've helped clients address the market. If the advisors listening have done annuities, they've helped clients address that income risk.
Yep.
Tax risk is this gigantic monster that has equal ability as market underperformance to reduce the dollars that go into your client's wallet.
I think as an advisor, I think that is a way to differentiate yourself. I bet that I just feel, without any statistics or data, I just feel like that's something that is not getting out to the public the way that it should, in the way that it should. Okay, so.
And the timing's perfect, right? We've had
Absolutely.
two extremely volatile elections. People are ready for the message. You don't have to convince your clients that Washington is doing some crazy, unpredictable things.
Yeah, that's pretty easy, isn't it? So speaking of Washington, let's dive back into your experience, and as you look up there, not talking parties or anything like that, but what do you see as the big challenges going on up there for getting anything done?
Yeah, I think the big challenges are that our government represents the truth of the American people, which is we do not have broad agreement as a nation on a lot of big priorities. So we're going to continue to see just a lot of volatility. America is a huge and diverse nation, and right now it is a little bit divided on the big issues. I think the challenge is both parties have spending in sight. They may not have spending on the same things, but I just don't see a path forward where somehow our government is spending less money. Part of it because our safety net programs are by law. Those aren't, Congress can't really impact those year to year without some major legislation. But part of it is just because a lot of that spending is for good things. We do need better education and better roads, and we have needs as a nation. That investment takes revenue, and that revenue comes from taxes, and those taxes, by and large, come from the kind of Americans that have worked hard, saved a good amount for retirement, and now are sitting on all those assets.
Do you see, I'm going to put you on the spot.
Yeah.
Do you see, how serious should people take it? Reductions of Social Security. Do you think that would ever actually happen? Just intuitively, if you took the word Social Security out of the situation and said, hey, we're paying people money, and you contribute, you pay, and eventually there's more and more, and the pot's not going. But then, of course, the flip side is like, well, wait a second, I paid into that, so I want mine back. You think that would ever realistically happen?
It's a good question. I think the more current risk is that just a complete Social Security benefit becomes taxable. So right now, the Social Security benefit is only taxable up to 85% of that benefit, but it didn't used to be that way. Yeah. At first it wasn't taxable, then they had partial taxation, now it's up to 85%. Easily, Congress could pass a new law that said for higher income earners particularly, 100% of your Social Security benefit is taxable. Immediate tax revenue, they didn't have to touch your tax brackets, but suddenly you have less money to spend off your Social Security benefit and the government gets to keep more.
Would a high earner, high net, at that point, would that almost be that would actually hit the wrong person? I could totally be wrong, but wouldn't that hit the wrong person because the person that has lots and lots of money is invested differently to where their money's coming out?
But they're still maxing out their Social Security benefit, so there's good revenue there. I do think over the long term they are going to take Social Security from, they may means test some of it and phase some of the benefit out. People like me in the 40s, I don't know that I expect to get my full Social Security benefit. I think for most of our baby boomers and clients today, they will get that same benefit, but it may be taxed differently. We talk about the way most of us think about our taxes changing in retirement by what bracket I'm in, but actually taxes can change not just by the bracket you're in, but how many deductions you can or cannot take, and by what new things Congress is going to tax, like your Social Security benefit.
That is so... the argument or the battle when it comes around Social Security, that what catches people's ears is, whoever the they is on either side, it's like they want to lower the amount, or they want to push the age. And really, like you just said, I hadn't even really pondered that. Just tax more.
Just tax it.
Just change the tax, and then you're not the bad person. You didn't adjust the age. You didn't lower the benefit, but we're going to claw back more of it.
Yeah. The scariest part is when Congress just gets creative on things that they can tax. It's like, let's dream it up. We'll be entrepreneurial, look around, where's money and what can we tax? And I think we saw that, I mentioned with the Build Back Better. They looked at all these IRA and 401k account balances and said we could get a little more tax revenue from that if we taxed it in a different way. So tax risk is really about the level of taxation that we have for your retirement assets. Legislative risk is about the structure of our tax code and how are we structuring taxes on your retirement assets? And both could have a huge impact on the amount of money that our clients have to spend in retirement.
Yeah. I think, you said something interesting is that we should be afraid when they get creative. And I think, today's crazy idea, like, that's crazy. Like, oh, wait a second. Let's go back
crazy.
Let's go back to what Johnson said last year. I always think about, and correct me if I may be wrong on this, but up until like the payroll withholding didn't start until the 40s.
Yeah.
And so
earlier.
I always think, because before that you would just, cut a check for what your taxes were total up at the end of the year. And then all of a sudden, whoever that person was we should all probably, I don't know.
Know their name, right?
We should either throw a rock, on one side we should all throw a rock at them, because what ends up happening is they go to payroll, start pulling taxes that way, so you don't really notice it. Because I bet if we all had to at the end of the year write a check in total for our taxes, one, we'd want to see an itemized bill, and two, we would probably all go crazy and be like, no, that's not how we're doing this, reform everything.
And most of the advisors listening to this podcast are probably independent business owners, K-1 employees. You do have to scratch that check out, and it is very, very different.
They have definitely a different attitude, which then, what we've been talking about, the diversification of tax risk should really resonate and really intuitively give a few people like, oh, wait, I guess I should be talking to my clients about this.
Well, and when we talk about the structure of the tax code, I'll preach on life insurance a little more, because I really do think that for many clients, it could be a valuable diversification tool within their retirement approach, not getting rid of an IRA or a Roth, but as a supplement, kind of a more complete approach. It's interesting that even advisors sometimes, but definitely savers, they tend to think of these products that we're saving under. But in the U.S., almost all retirement savings is done under Section 26 of the U.S. tax code. So Section 26 has a section 401k of Title 26 of the U.S. tax code. Section 401k of Title 26 covers 401ks. Section 403B of Title 26 of the U.S. tax code covers 403Bs. IRAs are in there. They're all in there.
Yeah.
Well, Section 7702 is also in there. And Section 7702 covers life insurance from the tax perspective, the tax-free death benefit, and the ability to access money tax-free through policy loans. I think what we have to shift our minds as advisors and then help our clients shift their minds on is it's not about picking a product to put our retirement savings in when it comes to taxes. It's about finding the section of the tax code that has the best benefits for those dollars. And I'm glad to have some of my money under Section 7702 because it's a contract. It's inoculated from legislative risk. I can get funds tax-free from it. It's not really about the product as much as what does the tax code and the structure of the tax code give me if I save money in that way.
Brilliant. I love listening to somebody who really knows. You're throwing out tax codes left. That is so awesome.
Probably the first podcast in history that tied James K. Polk's legislative priorities to financial advising. That
Bring
alone.
back Polk.
That's right.
So as you look and put on your prognosticator hat, look forward 12 months from now. What are things that you find interesting and exciting, and what are things that you're like, well, we're a little concerned about that?
Within Washington?
Within the industry.
World, within the industry. I think that we are going to get a little whiplash in the industry on interest rates. Right now, for years we've been like, look at this low interest rate environment. There is nowhere to grow safe money.
Yep.
And this past 12 months, we've really seen that change. I think what's going to give us a little whiplash is the second the government and the Fed can get this inflation under control, they're going to slam down those interest rates again. And the reason they're going to do that is quite frankly back to the debt.
Yeah.
We've got $31 trillion in debt. If interest rates normalize at 4 or 5%, we're talking an extra $1 trillion a year of debt service alone.
Yeah.
It is unsustainable to our country to keep interest rates this high. But savers are kind of not prepared. It's like they've been on this roller coaster ride.
Sure.
So I think we need to be careful that we're not so much abandoning this balance between safer fixed and equities.
We need to take a longer view on
We got to
this.
take a longer view. These interest rates are not going to stay where they are. And I think that's going to be very interesting. I also think we're going to see, regardless of, we got a big presidential election coming up with a new Congress. I think Americans are going to start to realize that the financial path our country is on is not party dependent, and that rising taxes are going to occur no matter really who's in office. Now, maybe for a year or two we can get some kind of reform. We could keep a little slice of taxes low over here, but as general, over now and the next 10, 20, 30 years, we are going to see taxes rise.
We just have to. I mean, it's it's just intuitive. If you run up a debt, regardless of the reason. I mean, we did have things that had to be paid.
Yeah, absolutely. A lot of that spending is good spending.
Yep. Yeah. But it's the bill comes due, and at some point we have to start paying for it and doing the things. If your credit card bill gets a little high, maybe you don't go out to eat. You just dial it down a little bit. So, Becky, it has been fantastic having you on the podcast. That chair, there's a spot there every time you come in, although I'll get that chair looked at so we don't lose you out.
Wobble it. I just get excited when I talk taxes. I really, truly believe it is one of the largest opportunities for financial professionals to make a significant impact in the success of their clients' retirement approaches.
And the next, it's on. We have 3 years, right?
Yeah.
3 years of basically taxes
artificially low taxes.
Yeah. It's time to, it's time to take advantage of that. But you got to know how and why you're taking advantage of that, which is things you teach.
That is right. We love teaching that. Well, seriously, whatever platform you're listening to this on, drop a note. We'll get you a copy of our book.
Oh, nice.
Let you read it, and you can learn all about all the risks that are facing. I love the title of this podcast because we also believe that kind of to be a complete advisor, can't just focus on the market, can't just focus on income. You got to help your clients with this tax and legislative risk too.
I love it. That's the perfect spot to end. So, like Becky said, please click like the podcast. Go ahead and subscribe, and then throw some information in the comments, and we'll get a copy of the book out to you. That's super generous of you. That is awesome.
Love to do that.
Becky, thank you so much for being here. And again, that chair is always open to you when you're coming through.
I'll come in next time I'm in Kansas City.
Love it.
This podcast is for financial professional use only and not for use with the general public. The information provided is the exclusive property of Creative One and is protected by copyright and other intellectual property laws of the United States. This material has been prepared for informational and educational purposes only. It is not intended to provide, and should not be relied upon for, accounting, legal, tax or investment advice. Creative One is not responsible for the results of programs discussed on this podcast or any liability stemming from the use of it. Although we may promote or recommend the services offered by this company, agents are ultimately responsible for the use of any materials or services and agree to comply with the compliance requirements of their broker-dealer and registered investment advisor, if applicable, and the insurance carriers they represent. Copyright 2022, Creative One Marketing Corporation.